Good morning and welcome to the Saxo Bank Morning Call. It is Thursday, January 31st, 2019, and here we are the morning after a pretty interesting FOMC meeting. We're seeing the Fed's Powell in the statement in a special release, really softening up the Fed's guidance on its policy mix, the market taking the bait and running with it, selling off the dollar, risk appetite a bit higher. We'll talk about the degree to which this is the case, but the key developments were, again, the special statement talking about a seeming willingness to second guess its current quantitative tightening schedule. That was seized upon in the immediate headlines as an interesting development, and obviously is a follow-on to previous language around its assessment of the QT policy. And then the guidance in the actual FOMC statement, this whole gradual rate increase language dropped in favor of sort of a neutral, we're going to be patient as we assess incoming data essentially and look at what to do next. So we're not getting an actual easing, but an easing up in terms of the Fed's stance. Clearly a willingness to react to incoming data, or if there's another, I think, of course, what prompted all of this massive meltdown in global financial markets we had in December. So if you look at a chart of Eurodollar, we're seeing a sort of a basic response you would expect. Eurodollar bulling up to the 115 old key range high level. We did go slightly above there, the nominal highs considerably above 115, but that is the, I think on a closing basis, the interesting level there. And then we're seeing the biggest moves in dollar versus the riskiest currencies. Of course, a weaker dollar is very positive for global risk appetite for emerging market assets, and we're seeing something like dollar versus the South African rand plunging to new lows for the cycle here on this news. So Peter, we talked about what this means in terms of the reaction function. Where are we in the cycle, the bear market cycle? We can look at past market history events around a switch or a turnover in the Fed's policy.
Yeah.
And we talked about a couple of instances or a couple of past patterns.
Exactly. We talked about specifically 1998 when we had the Asian crisis that also took a banking bailout for the Chinese government, and we came back and we got additional 2 years of growth and bull market until we hit the peak in 2000. And then the other scenario you sort of sketched out before we went into the studio, John, was the 2007 analogy, where you had that in September FOMC meeting in 2007 where they changed the policy and went below expectation on the interest rate cut, and that really
a policy panic, if you will.
A policy panic, just like we coined in this Q1, and that took equity markets to a new high in October, and then that was the peak, and then the rest is sort of history. But if you go into the slides here, you can sort of see those two scenarios. And
the one on the left, the little circle there showing when that actual policy move was made in September of 2007, and then the brief high, and then on the right, as you indicated, the panic move to deal with the Asian financial crisis.
Exactly, and I would probably say that if you take the rally until up to the point where we had the beginning of the drawdown, the 1998 probably looks more sort of attuned to what we have seen. It was a 20% decline in U.S. equities because of that Asian crisis, and then it was a very sharp reaction back to new highs. And I have said to clients, I'm pretty glad I didn't say go zero equities. I always maintain around 35% because we could be wrong. And now it seems like the Fed is delivering, and if China is also delivering more stimulus, who knows? Maybe we could make new highs in equities. I would not be surprised actually, given everything we have seen in the past years. At least short term.
New highs, that's some ways off, but certainly you got the groundwork there when you have the central bank shifting to an easier policy. I'll tell you, and on rates, we didn't see much of a reaction here.
No, we didn't see much a reaction. We have a graph here that shows the 10 years U.S. Treasury yield that at the moment is trading around 2.67%, and yesterday was trading around 2.70%. So we're talking about 3 basis points. The yield curve steepened a little bit, but we are talking about 2 basis points more or less. We are not talking about huge movements. So in reality, for the bond market, it didn't change much. But I believe that the message of the Fed has a big 2 takes for bondholder. The first one is that there is an economic slowdown that the Fed is obviously scared about at this point. And this means that weaker corporates are going to start to default probably. And we are going to see at a certain point this year or next year an increase of defaults. And the second point is that with a dovish Fed, credit spreads are going to be supported. So there is plenty of opportunities for investors to start to switch from riskier assets towards more safer assets.
Okay, so the classic credit crunch cycle in corporates swinging into motion at some point over that. You brought a chart, not much of a segue here, but I think it's very interesting. We're looking at the Fed is clearly at least moving into a very neutral stance and ready to react with actual outright dovishness. The ECB has already sort of started to make that shift as well. And it seems this is the Italian BTP yields. It doesn't seem like the market is playing this at all from the old existential threat angle that it was before.
Yes, exactly. I think that as you can see in this graph, the BTPs, the yield of the 10 years BTPs, has started to retreat from the highs that we have seen last October. So before it was trading at 3.6%, and now it's trading around 2.5%. But today I think that it's a very big day. We have Euro area 4-quarter GDP results out. And I think that the GDP results of Italy are going to be very interesting. The market is expecting it to be at minus 0.1%. And this might be a signal that Italy is coming into a recession. So obviously, if Italy is entering into a recession and there are rumors that there is a more political clash between the two leaders of the government, and we might be entering in early election this year, then we will probably see the BTP falling, even more than what we have seen last October.
I can't help but remark that short charts here. The 10-year U.S. trading 267 basis points. The BTP at 2.56 or 256 basis points. Apparently, Italy funding itself in essentially a foreign currency, the euro, a currency which it cannot print. Safer than U.S. Treasuries. I'm fascinated by that idea. I wonder if I can see your point, but we'll need to see the ECB coming to the help and helping to fund the shortfall that is basically Italy can't fund itself. So this will be very interesting. Doesn't look like a good deal to me for the cycle, even if we do see lower yields with the assumption that those existential threats don't come back into play. Now, a lot going on here, Peter. We got earnings coming in fast and furious this week with all of the really swinging into full gear this week. What did we see yesterday?
It's a very busy week, as you say. 400 earnings of the ones we tracked this week, and we have a broader calendar with you here. Generally, the numbers for U.S. companies are exceeding expectations, both on the top line and bottom line for most companies. Today, the two most important earnings are Amazon and MasterCard. We're seeing a little bit of weakness in Europe as expected and in Asia. And then tomorrow, we'll have ExxonMobil and Chevron from the energy side, and Novo Nordisk, one of the big ones in Europe. We have some in Europe today with Roche, but also Royal Dutch Shell. But I think Amazon and MasterCard is what the market is looking for today.
But what about outlook? I mean, outlook-wise, aren't we seeing pockets of caution? We've talked in recent days about Intel, about other companies.
They're all quoting or citing increased uncertainty on the outlook. It doesn't seem like a lot of companies are committing to very high expectations for revenue growth or profit growth simply because of the outlook. And
a couple of very high-profile names yesterday out with Tesla and Facebook. Which one do you want to talk about first here?
Let's go straight to Tesla. So what happened was that they delivered another quarter of growth. They have a pretty, I would say, optimistic forecast for their growth margin on the Model 3, 25%. That's in line with the industry. As you can see, marked with the orange circle, shares were down, and that was mainly related to the fact that the CFO is now retiring, and a 34-year-old millennial is now taking over Mr. Kirkland to run the business. I just put in the chart to the right. It's the Bloomberg's Model 3 tracker, and as you can see here, it seems like production is ramping up again for the Model 3. They are expecting around 360 to 400,000 deliveries total across all models for this year. So.
And then Facebook, so embattled. I mean, clearly the news cycle is really picking apart Facebook left, right, and center. But we're seeing what was a very positive report, at least according to the market, and this big jump.
Jumps 11%, and as you can see here, they really exceeded expectations on revenue. But I think maybe the chart's a little bit too small. As you can see, the share price is down. That's the PR story that you talked about. Seems like we're now moving into a rebound phase. The monthly active users is clearly now saturating and being flat. I still have hard trouble on grasping the numbers. I'm wondering whether they maybe have they changed the definition of an active user, because I wonder why it can still be just flat in the US given everything that is happening, and there are sort of rumors that engagement is down. But if it's across the entire network of Instagram and Facebook, maybe it makes sense. But I think the crucial thing is actually, if you look at the table, you can see revenue was up 38% last year, but you actually have cost up 51%, and that's the story of Facebook, that you will continue to see margin pressure on the business because of IT security and moderation of all the bad stuff that is flowing into the newsfeed.
A lot more overhead, especially the political liability there. And finally, if you want to make a brief comment on
Boeing. That's very brief. I just put in Boeing here because it's a cyclical name. We had weakness from Caterpillar, which was definitely a China story and an Asia construction story. But then you had, on the other hand, you have Boeing, which is 35% commercial airliners, and they don't seem to be slowing down. The backlog is historically high. They just crossed $100 billion in revenue. You can see here in the EPS numbers, and revenue on them just smashing estimates. And as you can see here on the price chart, it's crazy, just gone from 300 to almost an all-time high in a matter of 3 or 4 weeks.
Tremendous move. You would think this is a pretty cyclical. I mean, they have a defense side as well, but a pretty cyclical industry. So if there is a hiccup reached at some point in air travel, I would guess it would feed back into Boeing. But for now, the story very positive.
Yeah, and what the Fed decided today, I think, is positive for Boeing, because cheap financing is good for aircraft financing.
So let's go to our, actually, just a point here on the gold chart. We've talked about this yesterday, gold being the single instrument most sort of associated with whether central bank policymakers are in an active mode or not. And of course, we're seeing new highs there after that Fed meeting. We talked a little bit about the response, Peter, and we didn't have a robust discussion, but questioning a little bit of lack of enthusiasm relative to what just unfolded. I mean, this was I would rate this, and I think the market rates this as, and commentators rate this as a very dovish surprise. The move to me looks a little bit modest. I'm wondering if the follow-on move could prove a little bit more modest than expected as well. We have the risk that, and we talked about this a little bit, that if the Fed has gone neutral, but for it to actually move into an active cut cycle and see real moves in policy, we're either going to need to see very bad economic data or a very ugly market meltdown. And if we don't get one of those two eventualities, I think we're not going to see the further softening up. So the question is how far, in other words, the market can take this. We'll see that, of course, in coming days and weeks. Now let's go to our calendar for today. As Altea mentioned earlier, we have that Q4 estimate up later this morning. And the Spanish GDP is out almost as we're speaking here. Some minor U.S. data points ahead of the big stuff tomorrow, that latest jobs report. Apparently nothing in there if Powell got a look at it to scare him away from this very soft message. And I must remark as well, Powell did not seem very comfortable or happy during that question and answer session, and was not impressed with his demeanor. And I'm wondering if he's doing a bit of soul searching here and has a bit of egg on his face in this big turnaround in the FOMC's guidance. That's it for us today. We'll see you back tomorrow with the week's final version of the Saxo Bank Morning Call. Thanks for joining.